Hello, everyone. Thanks for tuning in for our how to budget a funding round session. We maybe some of you guys came from the webinar that we did yesterday on our main channel on funding rounds, but this one is much more focused on the I don't want to say technicalities, but on the work on the complications around forecasting and budgeting for startups, which is I think it's a little bit of science, mostly a science, a little bit of an art, but honestly, mostly overwhelming for so many companies. So we want to demystify it. We're literally going to be building a financial model for you guys on the Zoom link. So by the way, we're streaming this on our Startup Club channel. That's where the recording is going to live. I always get that question. But for you guys on the Zoom webinar, we'll have a moment. You'll be able to raise a hand, and we'll pick a few companies, few startups from the group, and we'll literally build out a financial model as the reason I do it within the span of this hour is just to kind of prove that it's not as complicated as you might think. So that's kind of the objective. So let me reshare my screen and we can get started. Oh shit. Wrong. That. Okay. Sorry. My bad. Here, not there. Share screen. This screen. There we go. Sorry for the hiccup. Okay, so that's the screen, and I tried this little trick Apple presenter overlay thing, which is a little better. I think it's a little better than the thing in the corner sort of situation. Okay, so uh, budgeting and funding round. Let's get to it. Lots to cover. The only reason why we know or why we talk or why we know how to do any of this stuff is because we've been helping founders prepare or like helping them arrange their stuff for investors for over 12 years now. About 2 million startups have signed up to Slidebean, and there's this problem that we keep seeing with the pitch decks that we were able to look at. It happens time and time again. First, that the round size is this random arbitrary number, right? It's, oh, we're raising around $1 million, or we're raising between $1 and $2 million. So it's this really weird, long, extended range that is just a reveal that somebody hasn't done their homework when forecasting the round. Problem number one. Problem number two is when assumptions are just this expectation of a huge hockey stick that just grows exponentially month over month. And you can see that in the charts and the revenue forecasts. It's very obvious that somebody didn't do their homework. They just added some number, multiplied it exponentially, and called it a day. And last but not least, we see this a lot where, hey, we're raising money for 18 months of runway, or we're raising money through the end of the year, but it's not tied to a milestone, to one of the milestones that would make you a venture backable company in the future. So the solution to all of this, or the question that you might have gotten, could be a pro forma template, could be your profit and loss statement. You might have asked yourself the question, how much money do you need to raise? But the answer to this question is a financial model. And a financial model sounds like a mouthful, and it does sound like a mouthful, and I don't love using the term, but it is what it is. And today, like I said, my work is helping demystify this and make it simpler and useful for you guys. So let's jump right in. Like, first financial model that we're looking at. Okay. Let's see if I'm just gonna wait for a sec. I think this screen should work fine. Like I have to like arrange it so it's like widescreen and it fits the width of YouTube, but you guys on Zoom should see it just fine, and let me know if you don't in the chat. Okay. So this is a financial model. This is the Slidebean, like or a version of the Slidebean financial model, just to kind of give you a sense or a glimpse at the first thing that we want to look at, which is the income statement and the color coding that we have in this thing, right? Because as you can see, we have revenue as green, we have costs as red, magenta, and we have sales, general, and admin expenses as blue. And this, I think that this isn't too overwhelming, right? This is basically a budgeting sheet. So if I were to start a company, and I'll just pick someone, Felix, I'm going to pick Felix as my co-founder from the Zoom link. Let's say that we're building a company, and we're assuming that we're gonna be co-founders, and we're gonna start paying yourselves a salary, say in October. So we have Caya, and then also Felix, who's gonna be CTO and is also gonna start in October. and here's an annual salary. Notice how this automatically takes care of dividing that by 12, right? So super simple, little drop down situation going on here so we can pick the month. So if we scroll down here to cash flow, what we're obviously going to see is that we're paying ourselves uh, nice a nice $100,000 a year salary, which means the company has to bear this $16,000 a month cost that just stacks up as we spend more and more money, 100K every 6 months. And that's not all, right? We have other expenses that we might need to do. We might be a little old school and need a little office situation going on. So let's do office here, like in WeWork space. Um, we might need laptops, right? So we might want to get some brand new MacBooks and spend a couple, say $4,000 in a couple MacBooks. So like this is really a budgeting, not too different from the budgeting tool that you'd use to budget your own life. And again, what this kind of tells us is, well, if this is our ending cash balance after all of this, and we need to raise money to cover, say, from October through January, right? We need to raise about 285. So we can add that here, the funding assumption, 300. And that's, this cash influx that comes in October gives us $300,000 and makes our cash balance not negative, right? But this is just a wish list, right? This is just expenses. How about revenue? How do we estimate how much revenue our new improvised startup might make? So in this sheet, I added a very, very simple metrics assumption section. You can see it here. You're going to have access to one of these sheets in a sec. Don't worry. So uh, chill. You'll have access to this in a sec. But what I added here is what I call the simplest SaaS business model in the world, where we have a few inputs. Notice that inputs in the sheet are all blue numbers, and anything that's being calculated by the model itself, formula results are black. So let's say that Felix and I start this company in October. We start building, and we expect to launch somewhere around February. So in February, we can say, okay, we're going to have about 50 new clients every month. 50 clients February, 50 March, 50 in August, maybe even more. So maybe we're going to be growing, right? So every month we're going to get whatever we got last month plus 10, right? So we're going to have this scaling number of customers from 50 new customers in February to 60 new customers in March to 70 new customers in April and so on. We have a churn rate here. So we have an assumption of, the fact that some customers cancel, and then we have a monthly recurring revenue per client. So basically we'll say, Felix and I agreed that we think that this product ought to be priced at 49 a month. So once we add that, notice how we've connected clients to MRR and how that's been connected to revenue, right? So now everything changed because, our revenue is growing. We're still burning through some cash early on, but in July, we actually start turning a profit. The money that we're making in July, which is about $17,000 worth of these subscriptions from 300 total customers, sorry, is actually paying our bills. So we become a profitable business. This is, in a nutshell, what you want to be doing with a financial model. Budgeting your expenses and forecasting what your revenue is going to look like. So it's not too crazy. It's not too complicated. Ideally, the color coding kind of helps navigate through this. And that's the general idea. Again, like I said, I'm going to teach you how to build one in this session. But before that, there's something really bad about the model that we just built, about this model that we just created. I'll call it trash. I actually, in a previous session, I used to let people download it and then kind of trick you with this plot twist of the model being trash. But I don't do that anymore because it's too many downloads. But can anybody figure out like why this model is trash? Like what's wrong about the spreadsheet that we tried building? You guys in the Zoom session, any thoughts? What's so terribly wrong about that model? Any ideas? Any takers? I'll I'll buy you coffee if you get that one right. So what's wrong about this spreadsheet? We budgeted some expenses. There you go. Okay, so Lydia's got it. Lydia says 10% month-over-month growth is unrealistic, and then I see based on unproved assumption. There we go. You guys got it. Great. Basically, what we did in that model is something like this, which is, by the way, a real a real pitch that I heard once from one of our customers. Hey, we're going to generate 700 orders when we launch, and then that number is going to grow 10% a month. Basically, what I, very not too different from what I did, which is we took that 700, we multiplied it by 110%, and we just dragged that formula to the end of the sheet and ended up with some really nice looking growth. In this case, because you're multiplying by 110%, or growing 10% every month, basically you've created a hockey stick chart. And you see these too often. Like you see these on pitch decks. It's like, oh, we're just going to grow exponentially. But why? Like, what are you doing to grow exponentially? So normally these charts don't work. And if there's any slide that you want to steal or any slide that you want to screenshot from today's session, probably this one, which is, this is basically what the model was doing, right? So we have green bars or positive columns in this chart as our revenue. And we have expenses and costs at the bottom, negative charts. The blue bars at the bottom are probably bigger, right? Because Felix and I were paying ourselves some neat little salary from the get-go before we even launched the product. And yeah, so those bars were bigger at first, but then the green bars kind of cut up to this. And we established that we want to make sure that the round lasts until a certain milestone, whether it's a round of funding or revenue goal. But what we need to understand, the most important thing that we need to understand when we're doing any of this stuff is understanding what's the driver behind these things. What are we doing, or what is the company doing to drive more revenue? And what is the company doing that's driving more expenses or more costs, right? There's some causality to this. Let's keep with the trivia question since you guys got it right the first time. So here's another trivia. So if you guys are a seed stage company, how much money should the company be raising? I'm gonna read them out so that I give some time to the YouTube folks to catch up with the stream. But I want to say A, 18 months of runway, B, whatever it takes to reach the next fundable milestone, or C, enough to launch the product. Lydia's hunting for some coffee, gave me an A. I see a B from Felix, a B from SQL at Gmail, Akshay C, Christopher B. Okay, so we have answers for all of these. Good. Okay, so let me start writing off some of these. The first incorrect answer here is C. The reason why C is not the answer is because if you're a seed stage company in this day and age, the expectation of a seed stage company is that you already have launched a product and that you already have revenue, right? So normally funding in this day and age works in fundable milestones. So, you raise a pre-seed to build a product, launch it, and the money that you raise needs to be enough to get you to seed stage. And seed stage is not launching the product. Seed stage is revenue, customer growth, a few, maybe $20,000-$30,000 in monthly recurring revenue. That's a good position to be in to go out and raise a seed round. So there's no round of funding that happens right after you launch. That's a moment between rounds. Between pre-seed and seed, you launch, and then at seed, that's when at 20, 30K in MRR, that's when you can start approaching investors to raise a seed. So C is incorrect because it's not, because again, by seed, you should have a product in the market already. For A, so A is also incorrect, right? So we established early that whatever money you raise needs to be enough to get to the next milestone, because if you only raise based on an amount of time, you might run out of money before you reach the fundable milestone. I'll tell you a story from my own traumas. We raised a seed round. We raised about $1 million seed round a few years ago, and everybody that advised me on this said, hey, you should raise for 18 months of runway, right? So make sure that your round lasts for about 18 months. Great. That's what I did. I budgeted, we used a little forecasting thing. We budgeted so that the money would last for 18 months. So 12 months into the company, I'm like, okay, I'm 6 months from running out of money. We should start pitching investors for our next round, right? So I did that, started pitching investors, and every investor that I sent the pitch deck to replied saying, hey, that's cool. It's exciting. I like what you're building. But we're a Series A fund, and you're not at Series A. Series A is about $2 million in annual run rate, and you guys only have $1 million in annual run rate. So you're not a series, but we're excited. So just come back when you have Series A metrics. And I'm like, I don't have money to get to Series A metrics. I'm going to run out of money in 6 months. It's not enough time to get to double my revenue. So to that point, the reason why A is not the answer is when you budget around, you have to make sure that the money you raise is enough to get to the next one. Because if you get stuck between two rounds of funding, for example, if you raise a pre-seed, launch, but don't have any traction, or like us, if you raise a seed, launch, but don't have Series A metrics, you're going to be stuck in a position where raising money is really hard. So the most crucial thing of this lesson is the answer is B. Whatever it takes to reach the next funding milestone, that's how much money you need to raise. Lydia has this good question on fund strapping, raising just one round. We talked a little bit about this in our webinar from yesterday, Lydia. Maybe Josh from my team can paste the link to that session. It's on our other YouTube channel. Well, you're on Zoom, sorry. So on our YouTube channel. We'll paste the link, but basically the answer to that is if you want to be a venture-backed company, if you want to raise money from investors at, say, a few $100,000 for 15% of the company, the only way in which those investors make their money back is if you grow really, 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 really fast. And the only way to grow really, really, really fast is by raising more rounds of funding. If you go to an investor and say, hey, like we're going to raise this money, it's the only round we'll raise, and after that we'll be profitable. I mean, that sounds cool for you and for the company, and it's less risky for sure. But for the investors, it tends to be a bad deal because it would take, on a 15% equity stake, it would take years, if not decades, to get their money back just on dividends. We talked a little bit about it yesterday, but feel free to watch the longer version of that answer. Okay, so let's keep going. So we understand that when we're doing a model and we're forecasting, even if it's at pre-seed, right? Because even at pre-seed, part of the money that we'll use is for marketing and for launch. We need to understand what's driving our revenue, right? So even going back to this slide on projections, right? What's the question was, what's driving our revenue, what's driving our growth, and what's driving our expenses, right? So what are potential in this case, orders, traffic, subscriptions, right? Like whatever your KPI is. And at the same time, what do these orders drive, right? When you have more revenue in your platform, orders, subscriptions, whatnot, there's an extra expense that you need to make because of that, right? Maybe it's the fulfillment cost if you're in e-commerce. Maybe it's the hosting cost if you're a SaaS. Maybe it's the support staff or account managers if you're a B2B platform. So there's some causality to the stuff that happens in the financial model. So if we have revenue at the middle, revenue at the center, we could say that revenue is a driver of our costs. In this case, the acronym here is COGS, or cost of goods sold. So the idea is, okay, the more revenue that we have, the more costs our company is going to have. So we need to be able to pinpoint, okay, what's a cost to us that scales because revenue scales. Classic example would be your credit card fees, right? So if you use Stripe, you're going to pay 2.9% per transaction. That's just what it is, right? So the more revenue you make, you're always going to have to pay 2.9% per transaction. And it's a decent chunk of money, decent chunk of change. And then on the other end, you have drivers, right? So the question is, okay, what do we do? What does the company do to drive extra revenue? And let me give you a few examples of some drivers. So one potential driver could be your paid marketing campaigns, right? So we could say that the more paid marketing, obviously, the more ads you run, if you track them correctly, search ads, display ads, retargeting, the more revenue you might generate. So that's one potential. Another one is outbound sales, right? So if you're more like a B2B platform, you need an outbound or a business development team that's doing outreach to customers. That's going to be outbound sales. Organic traffic could be another potential driver, right? Where you have social media or SEO or PR as a driver of new leads. Or we could even have returning customers, right? So the assumption that some customers come back, subscribe, and will purchase something again from you. But not all these drivers are created equal. Some of these drivers are expenses, really. They're direct expenses. For example, paid marketing and outbound sales, right? So if you want to assume that the driver of your growth is Instagram ads, then you have to budget the cost of those Instagram ads. If you want to assume that the cost of the growth in your platform comes from your sales team, you have to hire the sales team, right? And pay for that sales team. And it's not the other way around, right? A lot of people think of it as, hey, we're going to have this revenue and therefore we're going to hire a bigger sales team. Not really. It's not revenue that drives the sales team. It's the other way around, right? You first hire the sales team or you grow the sales team, and then that's what causes the revenue to grow, right? You can use some of those funds to pay for the team, but it's one that's driving the other, right? Think of it like a formula, like a flow chart. Now, these other drivers also have expenses, right? For example, organic traffic would be driven by a marketing team. The difference between organic traffic as a driver and paid marketing is that organic traffic is not directly connected to the team, right? So for example, if you have a really, really solid SEO team, I think we're not too bad at SEO. Our website gets around 300,000 hits a month from search. That was a really big effort by our marketing team years ago, that now just became more of a maintenance effort. So the size of the team is not necessarily the size of our traffic, right? It's not directly correlated. We have to remember that there's a team that drives organic traffic, but it's not a direct connection that if we double the team, we double the traffic, because that's not how it works. Same with retention. But the point is that all of these inputs, all of these potential drivers are drivers of revenue. And the key to doing a financial model, the key to forecasting your growth is understanding how these drivers connect to revenue, right? So if we have paid marketing campaigns, right? If we have ads that we're running on search or ads that we're running on Instagram, how do we connect those to revenue? Well, through a cost of acquisition. Same with a sales team, right? If we have a sales team that's driving, that is our main driver of growth, there may be cold calling, cold selling, cold emailing people. It's really their sales, the number of sales per agent or the number of deals closed per agent that's going to drive our revenue. On organic traffic, it's going to be our conversion rate that's going to drive signups and potentially revenue. And on returning customers, it's the churn rate, right? So we've kind of established some correlations here, right? We have the drivers, whether they're expenses or not. They connect to revenue, and there's this KPI in the arrow that connects one to the other. So that starts to become a bit of a flow chart, a bit of a system. By the way, if you just joined the YouTube live stream, we're about to kind of jump into modeling one of these, or I keep actually building one of these for you guys in the Zoom link. Zoom is in the chat, in the live chat. For you guys on Zoom, if you want to raise a hand, we're getting to actually building some models for you. So if you want me to build one for you, now's your chance to raise a hand. Okay. You'll just need to tell us a bit about your company, and that's all. Okay. So we have revenue, green box, green color coding. We're going to use this for the model maps. Cost of goods sold. Again, that's everything that you have to spend because you made revenue. I talked about payment, credit card fees. Another example would be if you're in e-commerce, the products that you sell. If you're in e-commerce and you sell t-shirts, the t-shirts that you print, the packaging, everything tied to these t-shirts, that's going to be your cost. Selling, general, and admin expenses, that's pretty much everything else for a company. So selling, general, and admin is your overhead, your staff, like all of that would fall into selling. And capital expenditures, which I normally don't talk about too much, which are kind of like larger expenses the company makes, assets that affect your cash flow. So these are some financial modeling basics, but don't be overwhelmed. Don't worry. Colors are going to help make this easier. Okay. So I built a few models as an example. I see your hands raised, Kunle and Christopher. Just a sec, almost there. Okay, so let me walk you quickly through a sample model here in e-commerce. So if you were to model, forecast how an e-commerce company would grow, we could take paid marketing, right, as a driver. Those are ads that you run in social media, say. And you could take organic traffic as another driver, right? So one is blue because it's an expense. The other one is white because it's a KPI. And then we convert paid marketing into cost of acquisition, and we convert organic traffic into website conversion rate. And that gives us new orders. Notice that for this to work, we need to know which orders came from paid marketing and which orders came from organic traffic. We can't just mix them all up together, right? We need to understand how many came from one or the other so that we can really measure conversion rates. Because if we only have one single metric of orders, we don't know which ones were driven by our ads. So that's not great. And then for every order that we get, right, for every new order that we get, we're going to have a revenue per order, right, just based on the average revenue per order. We're going to have a shipping cost. Every order has a box and mailing and postage. And then we have a markup. If we do the inverse of the markup, we can find what the cost of goods sold was, right? So the cost of our products. That's a very simple, very basic e-commerce model. Let's do one more as a sample. A common one is a self-service SaaS, right? So the self-service SaaS would be something like ClickUp, like Netflix, I guess it would be a self-service SaaS where this is a product that well, it's not software, but streaming. It's a Google Drive and their paid subscriptions. That's something where you sign up via paid marketing or organic traffic, right? Just people discover these products on their own. They sign up. We have free trials. There is a free trial in these platforms, and then a certain percentage of these customers convert, right? So we have to track free trials, where they came from, and then a conversion rate to customers. And then finally, that gives a subscription. And then for every paying customer we have a hosting cost per user. And that's essentially how self-service works. Okay. So we have a template that we use to build these, and I'm actually going to build one for you guys. So Kunle, you raised your hand first. Let me bring you up and take it from there.
All right. What would you like to know?
Sorry, my iPad with the chat thing is about to run out of battery. Okay, Kunle, can you hear me?
Yes, I can hear you.
Sorry, I think I got you, but say something again.
Yes, I can hear you. Can you hear me?
Cool. Yes, I can. Thanks, Kunle. I hope I'm not butchering your name.
That's perfect.
Okay. So why don't you tell me a bit about your company, Kunle, and we can build this, we can map this out.
All right. So we're building a two-sided marketplace where professionals can get access to jobs. So it's similar to Upwork, but more for artisans and people doing physical work. So like plumbers or tailors or things like that. So I like to call it similar to Upwork, but it's a very different business model in general.
Okay. So yeah, so we have professionals and we have customers, right?
Yes.
How do you find professionals?
Right now, we believe we can use social media to do the advertisements to find people that would actually post and ask for help, which are the customers. The professionals, same way. We basically want to use like footwork, basically going to shops and where we can find people in their businesses and ask them to sign up. So two ways of doing this, but mostly online.
Okay, that's good. So paid marketing is the driver right here, cost per sign up of professionals. How about customers? How do you go and find them? Is it also paid marketing?
Yes, primarily we have to rely on paid marketing for both of them.
Okay. Let me. Okay. So these are going to be different campaigns, and that's the clarification that I'll make, right? So some of this is paid marketing, I'll call it paid marketing 2 and paid marketing 1, because one of your paid marketing campaigns is for professionals, the other one is for customers, and we need to track how they convert differently. So let's just keep them as separate. Okay. So professional signs up. Do you charge them anything to sign up?
No, it's all free.
Okay. Um, and customers, I'm assuming you also don't charge them anything. There's no subscription component to this.
Yes, no subscription.
Okay. So the idea is that customers will sign up, will purchase one of these services, right? Let's call it services purchased. How many services do you think a customer might purchase in a month or in a year?
We're thinking one.
Okay. One a month?
Yes.
Okay. So for every customer that you get, you have a certain number of services purchased. In this case, let's make a clarification that this is going to be new customers that come into the platform. And, those customers will become active customers that are this set of users, this set of customers that become active, right? That regularly make orders. And this active number of customers has a churn rate, as people may have a bad experience or they just don't need it anymore, and then they'll churn out. So we'll have a diminishing number of active customers that we need to make up with new customers. That gives us services purchased. Okay, so how much is the average service, you think?
The average service, I would say around $20 to $40.
$20 to $40. Sorry, services business revenue. And then we have, yeah, so 20 to 30 or 40. Okay. And then finally, I'm assuming you keep a percentage and then you pay the rest to the professionals.
Yes, that's correct.
How much is that?
We'll be taking around 10 to 15%.
Okay. So whatever you purchase in the service minus, let's call it minus 15%. And this is the payout, right? So you collected all this revenue. You have to pay your credit card fees for it because it's gone through your account. It's in your books. So
Mm,
it's your revenue, but then it's paid out to the professionals, right? Which goes here. Now the interesting, and this is kind of a base model, right? So uh, simpler version, but this is basically how a marketplace operates. The only difference here is um, the number of services available, right? So the number of services purchased per customer is kind of connected to the number of professionals, right? So there's a direct connection here because if you don't have any
mm,
professionals in the platform, there are no services that you can sell. But also there's a point where you have so many professionals that it doesn't make a difference. For example, if you have
mhm,
1,000 active customers and 2,000 professionals, or do you sell more than if you had 10,000 professionals? Probably not, right? It's just a matter of choice. So these numbers are kind of connected to each other, but none of them drive the other. You just have to remember that, or the company has to remember that
mm.
while you're bringing in customers, you also need to bring professionals, and you need to have this number be, um, let's say, uh, logical, right? The amount of services purchased with the number of professionals. But yeah, this is a
Right.
basic marketplace. So we're gonna build some of these on an actual spreadsheet. I'll show you how in a sec. But thanks for giving us the overview, Kunle. Let me bring Christopher and build another one, and then we'll jump to the sheet.
Thanks, Kaya.
All right, Christopher, why don't you tell me a bit about your company?
Hello, can you hear
Hey,
me?
I got you.
Perfect. Okay, yes, so it's I'm the one building the B2C software who asked the question yesterday. So it's like a B2C software mainly, but we also are exploring B2B2C, like selling through insurances and stuff, and then also potentially one day B2B. But at the moment, it would be B2C and B2B2C. So
Okay,
yeah,
let's pick one. Which one do we want to model first?
B2C for sure.
Okay.
Yeah.
So
Yes.
B2C, these are customers. Who are they? Are they anybody? Are they
It's
I mean,
it's a software for focusing and avoiding digital addiction. So it's against, social media and TikTok and all these other
okay.
things people can be
Okay, that's fair.
addicted to online. Yeah.
Uh that's customers. Okay. So is there
Yes.
a free version to it?
Yeah, there's a free version and then there's a free trial of the paid version and then there's a paid subscription. Yeah.
Okay. Let's say free trial. Yeah, let's call it signups maybe.
Yeah,
Free trials and customers.
exactly.
Paying customers, right? So this is a subscription. How much is the subscription?
It's $5. I'm just had to translate my currency. Yeah, approximately $5.
Okay.
So,
Okay, so subscription is around $5. Okay. Signups. Now, how do you get signups?
so we're exploring different, like it's a very new company we just launched a month ago with like a pretty bad product to begin with because following some advice. So it's organic and virality and then paid marketing maybe, but it's probably too expensive for our margins.
Okay.
Yeah.
This is this an app?
Yeah, it's an app. Yeah.
Yeah, organic. So let's go to organic downloads. Actually, let's use this, right? Organic downloads. And then, yeah, obviously there is a team that drives this,
Mm-hmm.
as we were saying, but it's your downloads don't respond to the size of the team, right? Really, the input is in the organic downloads. The team is just a reference to say, okay, how big of a team do we need to achieve this certain number of downloads per month. Okay, so that's a good reference. Thanks, Christopher. So we're actually going to jump in and build these on a sheet. So give me just a sec to rearrange my screen once again. Okay, so we're building one. Again, one of the, kind of recouping on the stuff that we want to make sure that we avoid as we're building this sheet is, we want to make sure that we estimate our round sizes correctly. We really understand how much money these companies would need to raise. We can't assume just 10% growth projections, right? We need to understand what's driving that growth. And finally, we need to understand that whatever money we raise needs to get us to a fundable milestone for each of these platforms. So the spreadsheet we're going to be working is here. Here's a QR code that you can snatch. My team's going to paste the link on the chats, both the Zoom and the YouTube chats. Kenneth, to your question, yeah, this is going to be live on our platform for a while. We normally keep it until we make a newer version of the webinar, so it'll be there. Yeah, so you can just snatch that link. And now I'm just going to walk you through that sheet as I build it. Go back to the other. Okay. So this is the good financial model, not the shitty one. And this is the one that's, again, free and available in our platform. So let's go to the FS month sheet, which is the same one we used before. And notice that this is kind of familiar, right? So we have revenue and cost and expenses. The only difference here, or the main difference, is that these numbers are all black, which means that these are not numbers that we're guessing. That we're inputting here directly, but these are numbers that are coming from somewhere else, right? These are the results of a formula. And we have a dedicated sheet for revenue, and we have a dedicated sheet for costs, and we have a dedicated sheet for staff and other expenses, SG&A. So now, we can more accurately start to estimate all the stuff that we'll need. So I'm going to go back to the other example. Felix, yeah, we'll paste this in a chat. My team will paste the link in a chat in a sec. So let's go to those milestones that we were talking about, right? So that, by the way, this model comes with a sample revenue line. I'm just going to disable it for now, so we're not distracted by it. But yeah, it has a sample SaaS and e-commerce, actually identical to the ones I showed you earlier. So those are kind of already built, but we're going to build at least Christopher's model today from scratch. Okay, so in the monthly sheet, it's clean, right? We have no expenses. There are no expenses at all. And the first thing we'll say is, okay, let's forecast, our funding rounds, our milestones. It's July now. So if Felix and I, as co-founders, were start to raise money now, realistically, we'd probably close more around January. So it's called pre-seed. We might start kind of doing this as a side hustle, maybe working on this product. It's Christopher's product. Actually, Christopher will be the third co-founder. That'll be it. But we all three will start working on this for a while for now, even though we're not paying ourselves. And we expect to be able to launch this, say, in April. And then after that, we need to figure out when we reach seed metrics and make sure that the money that we raise is enough to get to that. But okay, with these milestones, we can start doing some work here in staff. Sorry, in assumptions. So in assumptions, notice that we have the founding team, right? So we can do Caya and Felix and Christopher. We can enable these roles. Maybe a more reasonable salary. More reasonable salary for all of us. I guess this depends on where you live. And then when do these roles start? Notice that it says that the start date for these roles is model start, which means that if we added them, we'd basically have that expense right off the bat. But we don't want that. We want to make sure that we only pay ourselves once we reach pre-seed. But notice that because we added that milestone pre-seed and launch, now we have those here available. So these start dates are kind of fed from the milestones that we set up here. And that way we know that we are only going to really start spending in their staff when we raise money. We might need a little bit of money for other stuff, even ahead of time, right? So maybe we can go to cost and say, well, we're going to have to pay for some AWS stuff while we build because we need those servers live. So let's maybe budget $100 every month for AWS because we'll start building now, and that's going to happen regardless. if you go back to the monthly sheet, that basically says that, well, we need a little bit of money. The model has like this equity funding start, but notice that here, we need about $600 to get to January. So we probably should do that. We also need to incorporate too. So that's another one that's important. If we want to raise that pre-seed round, maybe somewhere around here, we'll need to file for incorporation. That's going to cost about $500. It's a one-time expense. So here in the monthly sheet, we have to remember that, hey, we need all this money, and probably it's the three of us that will need to pitch in. So maybe let's say, we'll divide it $500 each. That way, that'll have us covered through the time when we raise the pre-seed. But the idea here is be realistic. Remember to add all of your expenses. Don't forget. So next up we have revenue. Well, the pre-seed stage, and let's do the revenue mapping. So like I said, we have a team that's going to be driving these organic downloads, and we can't forget to add that team. So basically, if we were to launch in April, we need to start building some hype around that early on. So maybe here in the staff sheet, notice that we have a staff sheet. We can get here from assumptions too. We have staff, and you can just click here. That'll take you to the staff sheet. Notice that here's us, Christopher, Caya, and Felix. Those were added from the other sheet, but now we can bring in a few more people, because if we're going to rely so heavily on organic traffic, we're going to need a team. So maybe we'll just classify them all as kind of senior marketing people. And instead of thinking of them as hires, let's think of this as a role, as a scaling team. So we can define that, let's say at pre-seed, we'll start building a senior marketing team. They'll make the same salary as us because maybe they don't have equity, so we have to pay them more fairly than what we're paying ourselves. And then we'll maybe have that team scale, right? Because we rely exclusively on this, we need to assume that maybe we'll have 2 new marketing people every quarter. That makes sense. And that team's going to scale to, I don't know, to 40 people, right? So we're going to rely heavily on organic. So we have to make sure that whatever's driving this growth, this team, needs to scale. Again, the number of downloads is not going to be directly proportional to the cost of our team, but we need to know that there's this team that's making all these organic efforts to get us to where we need to go. Okay, so let's now build this functionality. I'm going to do that here in the assumption sheet. And think of assumption sheet as a bit of a dashboard place where you can forecast expenses. Notice that we have a chart here where we are seeing how those expenses are scaling, and they're just costing us a shit ton of money. So let's try to start making this up with revenue. Okay, so organic downloads. The way I normally like to map organic downloads is something like this, where I say, okay, organic downloads at launch, right, the first month, growth or monthly growth, and max monthly downloads. So here I can just I'm just going to steal the formatting from one of these. These are numbers, right? So we'll say that at launch, we'll get maybe 1,000 downloads. That number is going to grow by 100 extra downloads that we'll be able to snatch each month, because we have a growing team, and we'll cap that at, say, 10,000 downloads that the platform will get a month, right? If we're really, really good at this effort, it's going to be scaling, and then it's going to reach this ideal moment where, okay, so let's keep going here. We'll convert some of these to free trial, and this is going to be a percentage. Let's say that 10% of them take on the free trial, and then a conversion to customer, then from free trial to customer, which is going to be, I don't know, 40%. And then the subscription, right? So we'll have a subscription, which is going to be $5, I think. Yes. And a churn rate, which is the number of people that get a subscription and then cancel in a given month. So let's say that our churn rate is going to be 10, which is a pretty standard churn rate for B2B products. So the subscription is a dollar value. So notice that here in the settings sheet, we actually have like the global currency value for the entire model. So we could actually have this model operate in pounds, right? And GBP. You can just change that or to euro, and changes not euro. And then it changes that across the entire model because in the end, it's just numbers, right? So it doesn't matter what the currency is. Okay, so those are the variables that we need. That's all we really need. So let's start connecting this. I'm gonna go to the revenue sheet. Oh, sorry, and then we also need a date for launch. So let's maybe I'm gonna steal the format from this launch date, and yeah, we'll pick a fixed month where we'll say April for the launch. Okay, so let's build this out. Here in the revenue sheet, we have some space. We have some KPI space to build stuff out. So let's just build this stuff organic downloads. And it's just, feel free to rewatch and rewind on the YouTube video, but it's really just basic formulas, right? Basic ifs and connections on a spreadsheet. So we'll say that if the month where we're currently in is the launch month, is the same as the launch month, right? We're gonna have 1,000 downloads, right? So let's just test that formula. We have to freeze these references, so we always reference the same sheet. But notice that here in the month that we launch in April, we have that 1,000 downloads. Okay, great. But we need to know what happens after, right? And what happens after is that, well, if the month where we're currently in is larger than this launch month that we defined, that's a drop down and reference, then the number of downloads that we get is going to be the number of downloads from the previous month plus the extra downloads that we assume that we're going to get. So let's kind of enter that formula and drag it along, and we'll see how that, oops, no, that's this one. Yep, we'll see how that scales, and we'll see that scaling number of downloads, right? So it's just growing forever. Again, but we set up a cap, right? We wanted to say that, for example, we don't want more than 5,000 downloads a month because otherwise that would be unrealistic. So again, we need to cap this number of downloads, and for that we can use a formula called min, which is the smallest of two numbers, just the smallest number either of that operation or our max number of downloads. And that's it. And all we really need is to fix the ugly false, because that doesn't look very nice. So, if it's neither of those cases, then it will just default it to 0. And that's organic downloads. And notice that as I drag that formula, what I'm doing is I'm just dragging, right? The same formula. It's changing the references and so on, and I am sticking with 5,000 organic downloads. Okay, great. Let's go to trials. So this one's a lot easier because we'll just take the number of downloads that we got times our conversion rate to free trial divided by 100. Yeah, it's a percentage. So 500 trials, 10%. Good. And then we'll have new customers, which is also a number. These are people that move from the trial to paid. So we'll take trials, multiply that by our conversion rate from free trial to customer, and drag that along. Okay, so 200 new customers every month is what the model is estimating. But these are subscriptions, right? So we need to build a little bit of subscription functionality in there. So I'm just going to jump straight into the revenue line 2. We'll call this subscriptions. Notice that it's blue. So it's anything, like, it's all color coded to know that anything that's blue is the number that we should be changing, or a value that we should be changing. And these are just, empty space for us to kind of work on our little formulas. So we'll say, with subscriptions, I normally like to work on something like this where we have new customers, lost customers, and total customers, right? So we can account for churn. We already have new customers. So I'm just going to move this from there here to here. The total number of customers is going to be the sum of, well, not even the sum. We're just going to take customers from the previous month plus new customers minus the customers that we lost. So we could just drag that along, and we'll see that number scaling in the number of new customers that we get. And all we really need now is churn, which is going to be the customers that we had last month multiplied by our churn rate of 10%. And that's it. So the model will account that we'll lose some people along the way, right? So that number kind of keeps, let's look at on month 1 just to see if our math is correct. We had 40 customers that we converted in the first month. That gives us 40 total customers. Great. Next month we convert 44, but we lose 4 because it's the 10% of the customers that we got. So 10% of churn. And then that gives us a total of 80 customers. So that looks about right. Looks like we got it. And all we really need now is to multiply this by our total customers by our pricing, our €5 a month. And that's it. I was going maybe a little fast. I was afraid of running out of time, but maybe that took like 10 minutes, 15 minutes. It's not what I'm trying to say is it's not a crazy amount of work to come up with estimates or with a tool that gives us realistic estimates. But this tool is giving us some really, really, really bad news. And the bad news are that look at this expenses line and look at this revenue line. It's just growing really slowly, not catching up to the size of the team that we need. If you go to the annual sheet, which is kind of like the annual summary, we have this problem, which is that this company is getting to about $117,000 worth of revenue right now on a forecast of $4 million in its staff. So something is really, really, really off about this company. Felix and Christopher, this is a point where we might say, okay, like let's brainstorm, like what's going on. Well, maybe we just need a lot more downloads, right? We just need to be much more aggressive about that. Again, downloads are driven by a team, so we can't just magically assume that we'll get more. But we can maybe be a little bit more aggressive, where we say, our number of downloads is going to grow by, we're going to get 1,000 extra downloads every month, and maybe our cap is not 5,000, but 20,000 downloads a month, right? That's a shit ton of downloads anyway. But let's see what that does, right? That definitely makes revenue start scaling a little bit more. If you go to the annual sheet, that gets us to $500,000 in revenue, but that's still not a very exciting company, at least not to get investors involved. Okay, can we do more? I don't know. Maybe this scales more aggressively. 3,000 downloads a month, max downloads of 50,000. Like I don't know what kind of platform gets 50,000 downloads a month. I don't think that many. So maybe I don't want to go that far. Yeah, maybe we grow faster. Maybe we cap it at 25. But yeah, I think that there's not much we can go from here. One thing we can check here is we can go to revenue and just see organic downloads and just see how many people download this app in the course of our model. If we just add everything here, right now it says that 1.5 million people have downloaded the app in the span of the 6 years that the model operates. So, I mean, it's not too crazy, right? It's honestly not that crazy. 1.5 million, there are more people with phone addictions. We haven't kind of reached the market yet. So maybe we can stretch this a bit more. Let's say 2,500 downloads. Now, I guess the next question is, well, let's just select a random month here and say, okay, let's say end of the model, December 2031. This company is getting 50,000 organic downloads a month. And what team is running that? If we go to the staff sheet and we can see the staff here, we have a team of 43 people, out of which, headcount, out of which 40 are marketing people. Yeah, I can buy that. I guess look at Duolingo. Duolingo is a really successful company, but I'm sure their marketing team is smaller or about this size maybe, and they're getting many more downloads. So that's one thing you can check, right, about how realistic this is. Yeah, but maybe it needs to be very aggressive, right? Maybe first month is slower, monthly growth is a little faster, cap is a little higher. But the point is, what this is showing is that even with these very, very aggressive numbers, I mean, we have to be very aggressive about growth first. We're still only getting to about $2 million in revenue, so that's not too exciting for investors yet. It's still not making us profitable with the size of this team. Maybe could we assume that our conversion rate to trial is higher? That's where you can start looking for references to see like what's a realistic conversion to free trial. 15%, I guess, would be high in my experience for like an end user platform. Free trial to user 40, I think that's realistic. Maybe we need to play around with our subscription pricing. Maybe we need to charge $8, right? That helps, right? That makes a bit of a change. It actually does get us to profitability at some point. So that's actually not too bad. So that's the idea of these models, right? To give you these tools, these inputs that they're kind of forced to think about when estimating. And moreover, when we're talking about rounds of funding, right? So we said that we have pre-seed here. We said that we had launch here. And if we establish that for a seed round, we need about 20 to 30,000 in seed in monthly recurring revenue, our seed stage would be kind of like here. So in October 26, we could start pitching investors for seed, and then around March, we could close the seed. So what the model has now told us is, well, whatever money we raise needs to get us here. So even if we haven't added every expense that we need, the money that we need is something like 450, right? Because 450, if we raise here, covers our expenses, covers our launch, covers our marketing team, and gets us to seed. It gets us to seed with only $2,000 in the bank, so maybe cutting a little bit too close, but that's the idea, right? Just budgeting to make sure that you always reach the next fundable milestone. Right. I want to make sure that I leave a little bit of time for questions. Sorry if that went a little fast, but you can always watch the replay. Just a quick commercial before I jump to your questions. This is what we do. Like this model, like I said, you can download it from here. Here's the link, financialmodel.slidebean.com/go. Grab the link. It's a free download, this model that I've just been using. After that, if you need any help from our team on building this, we can help. So we have a plan called Slidebean Accelerate that includes one-on-one sessions with our pitch deck team, one-on-one sessions with our financials team to help you prepare all this stuff. It also includes everything in our platform, from our cap table tool to our investor finder tool, of course, to our pitch deck builder. Those one-on-one sessions include sessions with me. So we do a kickoff session and then a strategy session once you're done with preparing your documentation. We also have a financial modeling plan. We call it fractional CFO plan, where our team actually builds this for you. So just like I did for Christopher's model, where we built a custom model based on it, our team can take care of building it, and we keep your model up to date. We sync every month to make sure that you're using the model correctly, or helping you with, or assisting you with modeling or with changes. Or in this case, for example, this company that we were modeling, maybe they need to experiment with a new financial model, with a new business model, right? What if instead of a subscription, we do a rev share with something else? Or what if instead of, what if we want to add the B2B to C model? So our team can actually build that functionality for you, just like I did today, so you guys can run and test it. And then just for you guys and at the webinar, either YouTube or Zoom, and just for today, literally, like this webinar, you can use the code webinar710 to get a 50% off on your first month on either plan. This is really just a one-day coupon code, so it'll only work today. And don't try asking my team to give you access to it tomorrow, because it only really works today, only for the webinar people. So yeah, if we can be useful with any of this stuff, take advantage of that. That's all I had. I can jump into some questions now. So let me stop the screen share and see if any questions pop up from either the Zoom people or the YouTube people. Give you guys a sec. No questions? No takers? Sure. I see Felix. Yeah, link in the chat. Already got it. Yeah, I think. Is everything so crystal clear, or was I just going too fast and I left you guys behind? Commitment on the subscriptions. No, there's no commitment on the subscriptions, except that you need an active plan to use the model that we built. So there's a plan where you don't have, the accelerated plan is the minimum plan that you need to use a custom model that we built. So there's no commitment, no annual commitment or anything. You just need a subscription to use the model. Nick is asking, hey, what is the worst thing that could happen to your financial model? I mean, you missed the price projections, etc. Hey, Ray says that signed up as a member. Great. Nick, to your question, I think the worst mistake that I see people make with financial models, I'm going to draw it out for you, actually, because it happens often. People think of virality, right? And I think Christopher mentioned virality for a sec. And virality is basically saying, okay, we're going to have every customer is going to refer other customers. So if we take customers and kind of do this looping thing here, where we say, okay, each customer is going to bring one extra customer, we've essentially created like literally a viral loop. I normally when we have to create these in the model because somebody assumes that some of their growth is going to come from virality, Like we really highlight them in yellow or red just to make them scary and warning, because I'm not saying that referrals or virality is not a strategy here, but the reality is that this is usually unsustainable. And having one customer refer other paid customer is also a really, really big stretch of an assumption. You could assume that customers will talk about it, and that because you have more customers, you'll have more organic downloads. This is still a viral loop, right? So if you put this on a sheet and you kind of connect one to the other, you're literally creating this loop reference that just makes the model go skyrocket really quickly. So to your question, Nick, this is one of the biggest mistakes people make. I'm not saying don't do it. I'm saying if you assume this virality, be very careful about this assumption. Like this number is very delicate because it can very quickly make assume that your model is going to be super successful when in reality is not or might not. Right. So be careful with viral loops. Christopher's asking, how do you become accurate in estimating something like B2B sales when it's something you're just starting out? Also, is reality impossible to get K factor to a reasonable amount? Like this K factor number. K factor is this number, also called virality coefficient. It's a metric people use. So it's not impossible to reach it. It's just I think that you need an inherently viral product to do it, right? So Facebook or a social network like Instagram is an inherently viral product because, or like Clubhouse, maybe one of the last successful social media platforms. Be real. People talk about it. You want to have their friends in there. It's free. So it makes it inherently viral because it's fun if you have more people in there. So people are kind of motivated to get others on board. If you just build a really useful platform, period, people will talk about it, but it won't be viral. It won't have a K factor of 1+, or I've never seen it. What happens though is, think of, there's this platform that does phone tracking, if you recall, like the Truecaller, I think. Like Truecaller is a good example of a company that grew mostly on organic downloads, and these organic downloads are mostly driven by PR. So they have something like this, where PR that they got just massively skyrocketed their organic downloads. But this is not viral. This is not virality. This is just really good PR. It's not viral. It's not a loop. So again, to your question, Christopher, virality is not impossible if your product is inherently viral. But if it's just a good product, it's probably not going to not have a virality coefficient. People will talk about it. There will be some revenue from referrals that we can just kind of sink into these organic downloads. But as in one customer driving one extra customer, that rarely happens. Lydia, we're actually counting on partners, healthcare providers as a resource of referrals of their patients. Yeah, that's very different, Lydia, to that point, right? So in this example, if we had a referral system from partners, right, we could have partners here as a box, right? So partners, partners drive a certain number of organic downloads, right? So this is downloads. I've just messed up all the formatting now. Downloads per partner, if you will. But what drives partners? Well, it's a business team, right? So business development team is what would be here. My God, sorry. A driver of partners. Partners have a churn rate. So we lose some partners that stop sending us referrals every month. But this is not virality, right? This is just math. Just like driver-based math like we've been doing in the whole session, but not virality. We have to understand what this KPI is. It's really important that we understand, how effective this team is at bringing partners, how long they stay, how many downloads each of these partners bring. But it's very much a down-to-earth assumption, unlike virality, which is sometimes a little too optimistic. Okay, I see your questions, Ray. Which video I can watch regarding proper equity allocation? That's a really good video. We have a couple of videos. I'm gonna find them and paste them in the chat for you guys. Slidebean, so startup club equity. Like most founders would be surprised that equity at sorry, own video. That founders retain a lot less equity than you might think. So found that for you and pasted it here, and then also pasting it in the YouTube live stream if you guys want to take a look. Sorry, looping audio. I got you, Ray. I got you. Sorry. There you go. Okay. Where can I download materials as a member on Slidebean, and how can I value a retail sector company at seed stage or pre? That's a long, heavy question, Ray. Happy to answer it in the in our sessions if you remember. But I'll answer the valuation part. So materials, again, any Slidebean account includes access to this financial model and includes access to the mirror board, the template where you can kind of work with the boxes. So that's all included. Ray, to your question on valuation. So startup valuations at the early stage, people like to think that companies are valued based on what these assumptions are saying, right? What these assumptions are throwing out. And that's part of the answer for sure. But not the main answer. Valuations, when there's no revenue or when there's very little revenue, are mostly based on your capacity to convince investors, on how many investors you can get on board, on honestly a little bit on macroeconomics and how people are, if there's money flowing. You would see these $2 million rounds at $10 million valuations with no revenue in 2021 because there was so much capital flowing, but you don't see that today anymore. You might see it for a repeat founder. You might see them raise money at a higher valuation, but if you're a first-time founder, your valuation is going to be lower. That's just what it is. So again, at pre-seed and seed valuations respond much more to the reality of the market and your reality as a fundraiser, how many connections you have, etc., than to forecasts. It's only after Series A that forecasts make up for a big part of how the valuation is estimated. That's not to say that you don't need the forecast, because you need to understand how much money you need to raise, right? Okay, more questions. I see Big Man, Big Plans. How do you get sponsors or angel investors? OPM is key, but how do you where can you get them? So, well, Slidebean includes an investor finder, which is a good start. Normally, you wanna. My recommendation always is use our investor finder, or any, if you don't want to use us, whatever finder you want to use. But use our investor finder to find investors that are obviously invest in your space, that invest in your company stage, and find LinkedIn connections to them. So like what we provide on the investor finder is their LinkedIn profiles. So you can find, you can literally click on everybody and see like, who do I have a second level degree connection with? And using that second level degree connection to ask for an intro, that's absolutely where I would start finding investors. Denny, thanks so much for videos. You're very welcome. And maybe last question for today, because I know we're over time. Andrew, who do you contact to sign up for Accelerate? That's an easy question. We pasted the link just above. Here, I'll just paste it again for you. No need to contact anybody. If you wanna think of it as a model map, Kunle, it's a self-service SaaS, you don't have to go through sales for it, and that changes the economics of the model map for sure, because we don't need a sales team for Accelerate. Oh, sorry, I pasted the wrong link. Kunle, my bad. Let me get it again. There you go. And sorry, last question now, Andrew. If struggling to find technical co-founder, is it a good plan B to outsource building out a fully functional MVP to one of the developer team firms? I'd say that's the worst idea. We have a whole video about it, and that's maybe the last video I'll paste. I think the dev shops are a really, really dangerous workaround to your predicament, Andrew, because one of the hardest things about starting a company is indeed finding your co-founder, right? Finding a co-founder is rough. You have to convince somebody to come work with you, not for you, but with you on this product where there's a lot of uncertainty, no money, etc. But it is also this very crucial test of your ability to build a team, right? If you can get people excited about what you're building, excited enough so that they that they join you regardless of capital, and that they're willing to work on this because they love this product and they believe in it. Like that's the level of belief that investors are expecting um, on a team before they invest, right? And if you go and hire a dev shop to do it, you're just going to spend a lot of money that you shouldn't have spent because it's your own money. They're going to charge you market rates for what they're going to do. So you're going to pay market rates for a product. And that product is 100% guaranteed going to need to change as you launch it, right? The moment any product, even the most experienced founders build a product, and that product needs changes, right? Stuff changes. Signups don't work as expected. Business model has to change. And if you have to go and pay that dev shop every single time you have to um, make any change, it's going to run you. It's going to be very, very expensive. Moreover, like investors don't like these companies because the risk, all the code and all the experience belongs to the dev shop, not to you or your team. So no, I'd say it's a really bad idea to go with the dev shop. I pasted that video on that for you guys. I'll paste it here in the Zoom link as well if you wanna take a look. Alrighty, guys. Hope this is useful. Hope to see some of you guys on Accelerate Plan. Again, I talk to everybody, every single one company that joins our Accelerate Plan. So hope to see you there. Remember that the code is webinar 710. Only works for today. 50% off on either of the subscriptions.